Hey everyone, today we're sitting down with John Drachman, co-founder of the Waterford Property Company. We are here at the Collective Apartments, 84 units in Newport Beach. And John, we're grateful to get together with you again. We had you on the channel about a year ago talking about Waterford's inception, the growth. We thought it'd be great to get real-time data as to what's going on the ground level as an apartment operator, what's going on with your portfolio, et cetera. So thanks for being here. And
yeah, of course.
Tell us what's going on.
Yeah, excited to be here again. Obviously, it's been a pretty dramatic change in the capital market since we last got together last year at the end of 2021. And it's been sort of a really fascinating and interesting time. You know, we have a little under 5,000 apartment units in Southern California. And to be transparent, actually, they're all performing really well right now. I think we've continued to see strong occupancies. You know, you just saw the city of LA finally lift their eviction moratorium, which, you know, I think went on for far too long. So I think that's going to be helpful to owners in LA County and the city of LA. We have seen operating expenses definitely rising a lot more than we projected. Specifically, insurance costs are a lot higher, payroll costs are a lot higher, and utility costs are a lot higher. So we're feeling the impacts of inflation. You know, rent growth at some of our market rate assets definitely is not growing as it once was. I think this project is indicative of that, where we saw really strong rent growth in the coastal markets of Southern California throughout COVID. You know, that's tapered off a little bit. I don't think you're seeing the really large rent increases that you once did. Even though we have some bad debt at properties, we're now finally able to, you know, evict and remove some of those tenants that have owed us a lot of back rent. Mm-hmm. And so we think the multifamily markets in Southern California can get back to functioning as they did pre-COVID. In Southern California, you know, you're still not seeing the large amounts of supply that you're seeing in other markets. So we still feel good about that. And I think we still feel good about Southern California. I mean, look at us. We're here on a beautiful day in October. And I think it's indicative of the fact that I think people are still going to want to live in Southern California. People are going to want to be here, so we're still bullish. I mean, it's not been without its challenges, and I think we are concerned about, you know, that operating expenses, you know, really rising. We don't see when that's going to end, so it's something to be really mindful of. But for the most part, our portfolio is doing really well in Southern California.
Great, that's good to hear, and that's what we're hearing in the market too. You know, Southern California has been really steady. I know other parts of the market outside of California, we've seen a lot of changes there. You've been vocal on LinkedIn. Yes, you've coined yourself Dr. Doom. Yes. Kind of talk to us a little bit about how you got that nickname and what's your thoughts there?
Yeah, so it's funny because, you know, we did a bunch in 2021 of these essential housing, workforce housing deals using tax-free municipal bond financing. And towards the end of last year and the beginning of 2022, those bond rates really blew out on us. We saw a lot of bonds being sold off. We saw, you know, really that market shifting a lot. And it really kind of gave us pause, because there's a lot of people that would tell you, if you follow the bond markets, that will tell you what's going to happen in the normal general economy. And so those bond markets really started blowing out at the end of 2021, beginning of 2022. So we started getting a little nervous, and we started thinking that this run we've had really since 2010 of sort of a great real estate market, you know, might be coming to a close. And obviously real estate is a very cyclical business. It always has been, it always will be. And we had a really good run. And so I think we started getting really conservative as a company, saying we had a really great run, but let's be really mindful and not overextend ourselves in this time frame where things are shifting. And I think we saw, because of the work we do in the bond markets, things shifting before I think a lot of people in the normal real estate markets, because you still saw record cap rates, you still saw record prices being sold. You still saw this in multifamily specifically in a lot of the Sunbelt markets, so Las Vegas, Phoenix, you know, Reno, all throughout Texas, Florida, Atlanta, Nashville. You saw continued record pricing, continued almost anemic cap rates that I would say are aggressive for Southern California, you know, sub 4, really almost sub 3% cap rates. But for those markets, historic lows. And so we started getting nervous, and I have a good friend of mine who's in the multifamily development business, who's actively developing all throughout the United States. And I think probably 6 or 7 months ago, I was telling him, hey, I'm a little nervous about multi, and I kept saying this to him, and he coined me the nickname, oh, you're like Dr. Doom. And so, you know, I had a post on LinkedIn once. I said, oh, I'm just going to call myself that and, you know, see if it gets any traction in it. I think people really either hated it or liked it. I don't know. I do think that I tend to be a pretty honest and blunt person, kind of always been that way. And I think, I figured on LinkedIn, as a mechanism, there's not a lot of people who are always, I feel like totally transparent. And so I thought, well, I'm just going to, since I own my own company and I don't have to report to anybody, I'm just going to, share what I'm seeing and thinking about, and it seems to have resonated. And that's just the nature of who I am. And so it's kind of tongue in cheek because, as you know, I'm not a really negative person. I'm a pretty positive person. Totally. But I definitely have felt, and my partners felt the same way, that we really have felt like there's certain markets on the multifamily side that have gotten way overheated, and that there's going to be some issues and some challenges with those. I think we're much more bullish about the prospects for Southern California. Candidly, Southern California has been a tough market since COVID hit because of the eviction moratoriums, because of some of the rent restrictions. I mean, in the city of LA, you can't raise rents, and you won't be able to raise rents until February of 2024. So a lot of operators in those markets would tell you it's been tough. So maybe we're a little bit more bullish because of that long term, because of some of that being removed. But in other markets, we're a lot more negative about the prospects of where those markets are going. I think they got way overheated.
So if you were to deploy capital in Southern California, like there's going to be opportunities.
Yes.
When and where?
Well, I think right now is a time to be conservative, and I think now is a time to think about things from a long-term perspective. I think if you bought a multifamily asset in a quality location in Southern California with a 7 to 10 year business plan, you'll be fine. Prices, 7 to 10 years from now will be up, rents will be up, you'll be fine. I think when you're thinking about multifamily, which isn't so much the case in Southern California, but certainly these other markets where they've been these trader markets, where you're gonna own it for 18 months and then flip it for a 2x equity multiple, I think that game's over. And I don't ever think that's necessarily the smart game to play in multifamily anyways. I think at Waterford, what we realized with some of our value add deals, this is a perfect example where we bought this, we improved it, and our plan is to hold this forever with our partners, is we tried to really structure a lot of our multifamily deals that way, thinking whether it was value add commercial, land entitlements. There were other deals that maybe you work on that are shorter term holds. But multifamily in good quality locations, I think, are really more of a cash flow business. And I think we got away from that this cycle because there's been so much capital going into multifamily. So I still believe, especially in Southern California, if you have a long-term outlook, now's not a bad time to buy. It's just if you have a 1 to 2 to 3 year outlook, maybe not the best time to buy. And I think that's especially true when you look at some of these markets outside of Southern California.
Absolutely. We've seen here in Socal, just the inventories are still razor low. There's not a whole lot to buy. Most people didn't get a lot of floating rate bridge debt. They had a long-term plan, or they at least got long-term debt to kind of ride through. So it's still been a very tough market to acquire assets in, and a lot of people out there, a lot of capital on the sidelines waiting to deploy. They're just trying to see, let's maybe wait until end of Q4, maybe Q1. Let's see what Q2 looks like. It's patient money. So we'll see.
Which I think you're going to see because it's Southern California, right? Our portfolio is very well leased, and I think that this Southern California, like most recessionary environments, will show that specifically on the multifamily side that it performs really well. It's a very safe asset class, and so I think that'll continue to drive capital wanting to be here. I actually think some capital got away from that and thought that it was better to be in markets like, let's say, Phoenix, where I'm very bearish on, because I think when you study the statistics of it, you look at the amount of new supply that's getting built. I think there's 28,000, almost 29,000 units under construction in a 350,000 unit market. So they're building almost 7 to 8% of their supply, and they've last 12 months absorption's been about 1,500 units. You're like, that's an issue where you could see vacancies double digits here by the first or second quarter of next year. We don't have that problem in Southern California. You also saw in that market, record levels of acquisitions done. They had more acquisitions done in the first half of this year than any submarket in the United States, over LA, Dallas, New York, and most of that was done with floating rate bridge debt. And so I think those are short-term business plans that in this rising rate environment, rising cap rate environment, going to be tough.
It's going to be tough. I remember that little blip being in Socal, and we had investors that exited, wanted to get into the Phoenix market, for example. And I remember some of that capital circling back because the cap rates at that time were 3.5, and you could get a four cap in Socal, and it was in a market they knew. And
which to me, that's just insane. I mean, Southern California historically has performed really well. We have issues with supply here from the standpoint of it's really hard to build. We're in the development and entitlement business, and I can tell you, even though it's gotten easier, it's still not easy to entitle projects here. In markets like Phoenix, hence why they have so much supply, it's very easy to develop there, or much easier than it is here. And so that's why we'll still always have a place and be bullish in Southern California. I do think there's going to be great opportunities in some of those other markets. It's going to take a while to materialize, but there will come opportunities from some of that pain. Yep. But that pain is coming because it's just simple math, especially in this rising rate environment.
So John, one of the great things about hearing your perspective is you've gone through a cycle before. You went through the down cycle of 08, 09, you went through all that. So I really appreciate your insight as to what's going on in the market. And if you think about it, for the viewers that are watching, some folks have had 10 years of experience, and that's a lot of experience, but they haven't seen a down cycle within that 10 years of experience. Yep. So it's kind of good to get your insights. What's your recommendations or just some thoughts behind it? Anybody that owns, maybe they acquired a couple buildings, what to kind of think about operationally, or just if you've got capital to deploy, what's your thoughts on, the cycle and mentally how to get your arms around it?
Well, I mean, real estate's a cyclical business. It always has been. And so you have to be prepared for the ups and downs. There's a famous developer out of Northern California named Buzz Oates, who used to say, if you haven't lived through a real estate cycle yet, you have never been in real estate. And so I think that in many ways, this is normal. These cycles happen. I think my career was really shaped because I was, really 5 years into the business when the 2008 great financial recession really happened. I was in graduate school, and it really has kind of shaped, probably made me a little bit of the Dr. Doom, because I saw sort of the pain of that cycle. So I've always had that in the back of my mind, and I've always recognized that real estate can go up and it can also go down, and it can get tough. So I think first and foremost, how Waterford's thinking about it, or how I'm thinking about it, is you want to think about cash. I think cash in these type of environments is king. You want to think about your different equity sources. What are the different mechanisms that you can have to either acquire assets and be in positions that if you see distressed, you can take advantage of. So I think we're spending a tremendous amount of time with our existing equity partners, meeting new equity partners to really make sure that we have a variety of different buckets of capital to take advantage of opportunities when they come. Because these cycles, while they go down, real estate will come back up. So it creates good opportunities. But I think for anybody that's younger in the business, I think, look, we're probably going to have less transactions, which could mean, less commissions, less money, less bonuses. So I think it's about being smart about your finances, your personal finances. I think it's being smart, not over leveraging yourself personally. And I think, we're spending a lot of time on asset management right now. We still own some commercial properties, so we spend a lot of time there making sure that the rent rolls are dialed in, that we're taking care of our tenants, that we're maintaining our cash flow, because that's really important. That the sexiness in a down market kind of goes out the window of acquiring assets and doing all that fun stuff. And it's really about the day-to-day grind. And so I think we're spending a lot of time in that. And I think these are the moments where if you're new and you haven't lived through a cycle, you've got to be willing to grind. I mean, I look at your career, Dan, as someone who's been a grinder. I look at myself very much the same way. Real estate's a long-term business. It's a marathon, not a sprint. So in these moments, you have to be in that mindset that you're going to get through it. And the benefit is that once you do, when you get to that other side, I think you have that sort of badge of honor, right? You have those stripes. And I remember getting through 2011, some of the older people I knew in the business looking at me going, okay, John, you're gonna make it. You lived through this, you got through the other side, you're gonna live through a good market, because at the tail end of a bad market, it's always a good market. And I think it gave me the confidence to know that I can get through a cycle in real estate. And so I would be, not scared if I was younger in the business. I'd be excited about it. It is going to be a grind. You are going to think about how you have to manage through that, but you will get through it. If you take it day by day and you take little steps to do things that you can do that will help you in the long term, I think everybody will be fine. It's normal. This is real estate. It goes up and it goes down, and you have to be prepared for those market swings and just take it as it comes.
That's good advice. That's really good advice. I mean, it's happening. The market happens to everybody. It's not just like an isolated incident.
100%.
It is all about cash flow and operations, and maybe you're not going to a very deep turn. We might get back to those classics with some upgrades, right? Optimally. Focus on making sure tenants are happy.
Really studying your occupancy, and if you see a dip, maybe increase concessions a little bit, maybe do things, maybe lower rent, just doing things so you maintain that occupancy, because that's going to be really important. And it's not just, oh, we're just going to keep turning and we're going to go on cruise control, right? I think it's being very diligent. We have lots of asset management meetings, so I want to know in real time what's happening. I just think that stuff's really important, right? And that's the blocking and tackling of real estate, right? Absolutely. But I think you mentioned a good point. The other thing is recognize that this is happening to everybody. We're all going through it. We're all going to experience issues in different ways. It's not just you going through it. So I think maintaining a good network, talking to people, some of that shared commiseration can be helpful, because you recognize that this is the way real estate is. It's a cyclical business, and sometimes it's great, sometimes it's a little tougher. But if you have a long-term mindset, you'll get through it.
Absolutely. Yeah, I think if you run it really sharp and tight, and if you continue that through the down cycle, if it's however long it is, if it's a year, 2 years, whatever it is, and when you do see the other side, if you maintain that level of sharpness, that's when you really see growth and scale. It's those people that learned in that downturn that we did and held true to those fundamentals. You don't let go of that, and you maintain that discipline, right? And I think because you just really think about things from the standpoint of, again, it can go up and it can go down. And so you want to play, I always say real estate's about playing 65% offense, 35% defense. I think some people in this cycle were playing more of that Hail Mary run and shoot, run and gun offense. And, sometimes it can get tough. And so you have to be prepared to play offense and defense. But these type of cycles are normal, and we'll get through it. Yeah, it's good. I always looked at it like it's developing your skill set sometimes,
100%.
And we're all going through that together. So
100%.
Well, John, thanks so much for sitting down again. We really appreciate it. You got a beautiful property. Your portfolio's, heading into any type of turn, you've really positioned yourself well within the portfolio and done really well, and we really appreciate your insight. So thanks for being here. Of
course, my pleasure. Always happy to talk, Dan.
All right, that's it. Thanks so much for watching, and we'll see you on the next video.